Good books and records are absolutely critical when you're selling a business. Poor books and records are one of the main causes that a business sale collapses or doesn't happen in the first place. So it's very important to get this right. This is part of a series of videos we're doing to help business owners that are new to the business sale process understand basic principles. In this scenario, we're going to cover good books and records and how important they are. It's kind of obvious when you think about it why it would be important, because the buyer is going to come along and they want to see into your business. As always, we emphasize that they're seeing with their heart and their head. And the heart part, we talk in other videos about a really good cultural fit, making sure they're the right person for the business, that they love the business and taking care of the staff and all those kind of human things, if you will. And then we have the head stuff that, as always, we have to worry about the pounds and the pence and make sure that we get that right. And this is in that zone. And the good books and records actually show us the real performance of the business. In the end, whatever offer they give you there's going to be a lot of math in it. They may have to get debt. The banks are going to look at it. They're going to have to know that whatever profit they make is going to be able to pay whatever payments they've committed to. All these different things are very important, and knowing exactly how the business is performing and being able to trust that is absolutely fundamental. If you have poor books and records, and when they start asking questions, the numbers are changing or wrong, and they can't rely on them, I can't tell you, it's one of the biggest reasons people get spooked and pull out of transactions. And so this has to be solid. And remember, as we covered in the valuation video, business value goes up and down with risk. The multiples go up and down with risk. And if your books and records are even slightly dodgy, more risk is perceived and the value of your company is going to come down. If your books and records and the financial analysis you can provide is rock solid, risk is going to go down in the mind of the buyer. And just sometimes consciously and sometimes unconsciously, your valuation is going to go up. So this is a very, very important aspect. So what do we mean by good books and records? Well, first of all, it starts off with making sure the basics, the company's house filings are in on time and they're correct. So this is normally done by your accountant, and it's important if you're in a business sale that these are kept up to date. So if your accounts were due 6 months ago and we start a sale process, we strongly encourage you to get your accountant to finish the filing so that the filed accounts are in. We can use the reports that are done by the accountant on an annual basis. The reason that's important is that your management accounts are fine, but the accountant does lots of things to clean them up, particularly the balance sheets. And those are kind of things we can rely on in their totality. So it's important that those are in and that they're accurate. Beyond that, we need management accounts. You need the ability to pull monthly financials out from your accounting system or generate in some other way. Normally it's the accounting system. So we can see how the business is tracking. This is very important. A business sale, generally, if you find a good buyer, a business sale can take up to 12 months. Even if you find a buyer, we go to heads of terms and run through the process, it's probably going to be 5 or 6 months. That's the reality. Everybody says it's shorter. I've done over 50 transactions. It isn't. It just takes time for one reason or another, including summer holidays and Christmas and all that. So, but in 5 months, a lot can happen in the business. And so people will want to stay updated with how the business is doing and how it's tracking. I've had many situations when I've been involved with transactions that we were doing a commercial model based on filed accounts. And as the transaction progressed over 4 or 5 months, the results started to go down and it no longer made that financial model viable. That's not uncommon. And so the buyers know this and they'll want to keep tracking your results. And so it's very important that we can produce those results fairly quickly. And I'm talking about basic profit and loss mostly. The balance sheets in accounting systems tend not to be too accurate, and people know that, but at least we can keep the P&Ls up to date if the balance sheets are accurate. And I know that's difficult sometimes in environments where you have work in progress, like construction and things like that, but we have ways of working around that. At least we can track top line revenue and other metrics. Whatever those other metrics are, we need to be able to provide them to demonstrate the business is still tracking. Beyond that, we need to produce management information that the buyer can see into the business. So we need to be able to show them sales by product, something basic. We need to be able to show them profitability by product. However you measure that, every business is different. We need to show them breakdown of certain admin expenses that are the larger admin expenses. We need to be able to show them payroll, who's on payroll, how much is being spent on property and things like that. So we need to be able to pull those and have good explanations about what they are so they can see financially into the business. Beyond the financials that you produce as M&A advisors, we're going to do something called a recast. What the recast is going to do is take your profitability, generally your operating profit, and then we're going to calculate a number called EBITDA, earnings before income taxes and depreciation and amortization and interest. And then we're going to calculate a number called adjusted EBITDA, where we actually add back things that hide the profit, things like your personal expenses. We call them Hawaiian holidays and Ferraris, or any one-off expenses and any non-cash expenses that might also be in there, to create a number called normalized or adjusted EBITDA. This is the number we use to start the valuation conversation. We did a whole video on valuation if you can go to get more information on this. But just to say that we need to create this recast with these add backs to come up to the adjusted or normalized EBITDA number. We need to know what the add backs are, and they need to be accurate. I have clients that have had literally, built houses inside the profit and loss that had nothing to do with the business, and we need all that documented, because what we're really showing the buyer is what the profitability is going to be when they buy the business. And if you've done things like taking holidays or even done things like had a fire or something like that are non-operational to the business, we need to be able to document that, because it's going to increase profit that the business is inherently making, and that's going to increase your valuation. But if we say that to the buyer, they're going to want proof that these add backs are correct. So it's just this idea of making sure that the books and records are accurate, it as something that taken lightly. I've had clients that do that they don't see that they need to really focus on this, and it always causes problems. It always creates risk, and generally those are the deals that don't close. Remember, 75% of transactions don't get from heads of terms don't close. And there's lots of reasons, and this is a big reason if it's in play, is that people can't get comfortable with the financials, and if they can't get comfortable, the banks probably can't for lending, and it causes all kinds of problems. So the trick is just focus on it. Now, a lot of companies have no way of making their situation better. I've been to clients that they're doing their best with the people that they have. No problem. We've got people that come as part of our team. That are accountants that will come in and clean up your financials and produce the reports and take care of all this for us. So help is at hand. Now that you know there's value, you will have to pay a little bit of money, but they will actually come in and clean up your financials and produce the reports we need for a business sale. And you need to understand that we will need to incur that cost. It's absolutely vital. A few £1,000s may give you hundreds of thousands in valuation, and take this seriously. We hope this has been helpful today. We've done this series to help people that are new to selling a business. We've also written a book called Selling Your Business that has 18 chapters on topics that are, again, targeted to people that are new to selling businesses. We're happy to give you a free link in the description field below to a flipbook version. Feel free to access that, and I'd be happy to send you a paper copy. Thank you for listening. Good luck in your business sale journey.